Our next guest is a tech investor on a self-declared buyer's strike, but he does say he's still bullish on the AI infrastructure trade. Paul Meeks, Harvest Portfolio Management CIO and Wall Street Beats partner, joining me now. Paul, it's great to see you as always here. You have been on a buyer's strike before when we talked. I feel like 2022 vibes is what I'm getting from you at this point. What's driving that buyer's strike for large cap tech?
Well, I'm not necessarily worried about the AI infrastructure trade and how we might be at peak AI infrastructure spend. What I'm more worried about, and this is reflected more in my technical analysis than in my fundamental analysis, is the chance that the current policies pursued here in the United States could lead us to a recession. And if we have a recession, I don't want to say all bets are off. There'll be good buying opportunities among the carnage in that situation, but that's my greatest fear.
And what do you think the likelihood of that recession is? I mean, most of the base case forecasts we're hearing from economists is that there'll be a slowdown, but either way, how is that going to play out for large cap tech?
Well, it depends within large cap tech. Are you consumer facing or enterprise facing company? If you have a company like Apple, which is essentially dominant in consumer electronics, they might be under pressure as the American consumer and other consumers around the world pull in on such spending. But on the enterprise side, we'll see what happens. I think when we have our hyperscalers report their results, and they'll be coming in the next 3 or 4 weeks, I think they will confirm their capital expenditures for 2025, which is really foremost for AI infrastructure and continued data center build and large language model building and inference for AI. So I'm expecting, unless we have a real dour outlook on the economy between now and then, probably triggered by Liberation Day, that we should have a little bit of a pop in these stocks, a little bit of a recovery when those companies confirm their AI spending, and they'll probably do that within a month from now.
And Paul, our executive editor, Brian Sozzi, had the chance to speak with AMD CEO Lisa Su about the potential for a slowdown in AI infrastructure spend. And here's what she told him.
There is no question we are in the very early innings of AI. Now, put some of the noise aside. So I am a big believer in this is the very, very early part of AI. The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years.
Paul, I feel like we keep hearing this, and I feel like it's not quite been realized. As she said, it's very early innings. I get it. But when are we going to get to even the second inning or the third inning in this situation?
Well, of course, whenever you talk to these tech CEOs, and I really admire Dr. Lisa Su for turning around AMD, she's absolutely brilliant. But they're always going to talk their book to an extent, right? That's just PR and IR. But I think that we're going to have an extended period of large language model building. We are starting to see some glimpses of inference. And once we get through the inference pipeline, then we'll see some hopefully pretty cool AI agents and AI apps. But unfortunately, when it comes to monetizing those agents and apps, I still think it's not a 2025 phenomenon. It might actually be next year.
And let's drill down on Nvidia for a second here, because I know going back to the beginning, you said even if you fundamentally believe in the case for some of these stocks, technically it's tough. So let's drill down on Nvidia. What level are you watching there? How far down does it need to go before you think it does get attractive here?
Well, I think valuation wise and fundamentally, it's very attractive. I was hoping for some stability around 104, 105. We're trading right there right now. But I'm not going to do anything before Liberation Day and all that hubbub. But I'm thinking 90 to 104, 105, where it's actually trading today, is attractive. Please don't buy it for the short term. We're not going to get a confirmation of how good their fundamentals are, probably until late in the month of May. And so make sure that you buy it for the long term. But I agree that it's going to be a big, big hit from here. And I'm very comfortable owning it for the long term at that dip in price level.
Gotcha. Paul.
is JP Morgan Private Bank U.S. equity strategist Abby Yoder and Bernstein's top chip analyst Stacey Rasgon. It's great to have you both with us. Stacey, I'll go to you first simply because we could have the lowest close of the year for Nvidia. When does the issue stop here? I mean, and what is the key problem right now, do you think?
Yeah, there's a few things going on. So, I mean, clearly AI, sentiment has deteriorated through the start of the year. The DeepSeek news was probably the trigger for it, although it's sort of funny that the only thing that's really happened from a demand standpoint since DeepSeek sort of came on the scene was demand going up, like not down. But it's clearly pressured sentiment. I think on top of that, when you start to layer in tariffs and just general like geopolitical uncertainty, I mean, it's hit a lot of stocks, but a lot of the AI names were also like high flying. And, given the increased uncertainty around spending environments and recessions and everything else, it's hit a lot of them pretty severely. So Nvidia, as well as most of the other high flying AI names, have had a tough quarter.
Does it feel to you like they've corrected enough?
Yeah, I mean, if the numbers are anywhere close to being correct, like the valuations mostly across the board are pretty attractive. If you look at pretty much all of the AI names, whether it's Nvidia or AMD or even Marvell or some of the others, they're all now trading kind of in the low. Broadcom, they're trading in the low 20s. If you believe in sort of the secular theme around AI, I think those are incredibly attractive valuations. The worry is clearly that people are uncertain about the earnings, right? So I don't know. I mean, that is sort of the big question. I would say right now, at least the demand environment still looks really, really strong. Just to pick on Nvidia, like I think they're going to sell everything that they can get out the door this year. So that just becomes the question: how much can they get out the door? But at this point, I would say like the only ones that really seem to be worried about the AI like demand environment seem to be investors, like the companies that are actually doing the spending right now. Their capex forecasts and requirements and everything, they're going up, not down. So, yeah, I think if the numbers are anywhere close to right, these valuations are very attractive.
Okay, that leads me to you, Abby. I mean, have valuations corrected enough across the whole tech space?
Yeah, well, I think Stacey's point, right, is around whether or not the E is correct. Let's say, and we're pretty confident that it is, right?
Oh, really? Okay.
Yeah, so we came into the year, the Mag 7 was expected to grow 19% year over year. It's down to something like 16%, which is in line with the negative revisions that we've seen with the overall market. But today, you're now able to buy the Mag 7, and again, they're not a monolith, but if we're going to group them that way, sure, at the cheapest level in 6 years, since 2016. Right, so that's a pretty attractive entry point if you believe in that secular growth trend, which we do believe in.
Of course, if we actually have a recession or a deeper slowdown, does that impact the way you would think about it?
Yeah, but like you also have to think about, okay, if the concern is around the consumer, the predominant client of these firms are enterprises, right? So they're a little bit more insulated in terms of who their end customer is and how they're spending. And you think about company balance sheets, the cash flow that these companies are generating. I think that's something that stands out to us as being a little bit more resilient.
What about the market overall? I mean, 10% pullback, retest the low this morning. Does the price action tell you anything, make you want to lean in one direction as to whether you, as I've been asking the guests since we started the program today, did we correct enough? Mm-hmm. Does the worst feel like it's past? Mm-hmm. What do you think? Yeah, I mean, I think there's some technical support around these levels, 5,400, 5,500. And again, I think the big question is this a clearing event? And the view isn't necessarily that it's a clearing event because you have to think about towards next week, we have earnings that are starting. So we're going to get some real tangible tidbits from companies around how they're thinking about what this outlook means for their corporate fundamentals. So it may not be a clearing event, but I think around these levels, we definitely feel comfortable at it.
Doug Clinton, the founder of Intelligent Alpha, stated in an interview that the major technology businesses, particularly those involved in artificial intelligence, have been underperforming for over a month. Clinton, however, remained optimistic about the industry in spite of the recent decline. He made the point that if we take a broad view of the industry and look at it in 2 or 3 years, we would still see a rise in AI stocks and significant capital expenditures. Clinton noted that if you support the AI trade, you should keep in mind that there hasn't been any volatility in the market for more than 2 years. From the end of 2022 to the start of 2025, there was a period of stability. Clinton described the present decline as the AI trade's first significant obstacle. He cited the dot-com era as the historical period in which the dot-com trade was first really challenged. Back then, it took 200 days for the turmoil to reach a new high on the NASDAQ. He explained that while this does not imply that the current upheaval would continue for 6 months, one must exercise patience during the downturn if they have faith in the AI trade. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video.
Still in flux, the words of the day. What does that mean for stocks?
Well, I think when you look at the market's response today, to us, it's reflective that a lot of bad news has likely been priced over the last number of weeks. I mean, we're down 10 from the highs. This is that retest of that, call it 5450, 5500 zone. Now, the retest is never fun, but we pointed out a couple interesting little facts kind of heading into the week. Note the VIX is below where it was really during the peak stress moment of mid-March. So is currency vol, so is bond vol. You actually had fewer stocks making new lows last week and this morning, despite the S&P trading back to that 5,500 level. Corrections are not fun, but remember, lows are put in on bad news, not on good news. And I think we've priced in, at least for now, a lot of bad news. I would suspect we rally out of this. 5,900, maybe 5,950 kind of being the top end of the range moving forward.
So you're approaching April 2nd, Wednesday, as a clearing event. It sounds like you're in the Tom Lee camp. Get this out of the way, and then we will have a nice rebound into April, though Goldman's Tony Pasquarello with a note today, not really sold on that. Quote, the big dynamics in the game have changed, and it's not obvious to me that April 2nd will prove to be that clearing event. Preservation of capital is the name of the game right now. What he's implying for certain, yes, sure, you get more tariff news and you get it out of the way, but the game has changed. The goalposts have moved. What does that mean?
I think if the game has truly changed, and this is just not a 10% drawdown, but the start of something more pronounced, frankly, it's not going to be a question that we're going to be able to answer until later this spring or this summer as we watch this market rally. Does it rally with the expanding breadth we want to see? Do we see new highs re-expand? Do we see credit conditions start to behave here again? Those are the big questions I want to ask over the coming weeks. But in the near term, the undefeated rule of Wall Street reigns once again. As prices change, so do attitudes. I mean, look at any investor survey here. They've been turned upside down. There's more bears than bulls in most of them. Look at the consumer confidence numbers that we've gotten over the last several weeks. There's certainly a degree of pessimism out there that at least gets me interested in thinking about, hey, could this be the clearing event? What could actually go right from here? I think very little attention is being paid on that, Scott.
Oh, it's funny. When you were talking about the rule on Wall Street, I thought you were talking about the Fed put, because that's what everybody is thinking is going to come into play at some point. I got Tom Barkin sitting right to my left waiting for the interview that we're all going to do momentarily. We're obviously going to ask him about that. Is that part of the calculus, though, that at some point you either have a Fed put, a Trump put, or a both put?
Well, with all due respect to Mr. Barkin, we always say in our work we care more about the message of the two-year yield than any Fed speaker. And I think the two-year yield, breaking back down to this 380, 385 zone, I do think is reflective that the market's expectations from the Fed here are starting to shift. Now, Scott, when you think about this corrective phase, let's remember financials have held up pretty well during this. This is not your typical financials are worse than the index. It's messaging some big financial issue that's out there. Financials went into this correction as your leadership. They've held their own during it. I think they're likely to come out the other side carrying the flag. Compare that to tech here. Tech did not go into this corrective phase as your leadership, nor has it provided any help on the way down. I think very, very unlikely tech returns as the leader some people might expect on the other side.
Doesn't that lessen the possibility that the market can do okay? I mean, if we're having conversations day in, day out about uncertainty, slowdown versus recession, and tech's not going to lead the way, but the rest of the market is in the face of all of those questions?
Yeah, I mean, markets bottom on bad news. I'll never forget that first pullback after the 2009 low when you got bad prints and everyone thought recession was coming back. That was the low of that pullback. I use a similar kind of framework here. The headlines are about as bearish as we've seen in certainly a number of years. That doesn't mean you can't go lower from here, but in terms of the tactical call, I do suspect a lot of this has been priced here. Whether it's 55.05, which was last week's low, or this morning, or maybe 50 S&P points lower, I generally think we're in the ballpark or in the zip code of what will be a tradable low as we get into better seasonals into April and into May. If something more sinister is out there, I think we'll see it through credit, and I think we'll see it through financials not showing up on the other side. So far, there's not a lot of evidence of that just yet, Scott.
Clinton emphasized that the topic is what kind of risks an investor wants to accept during the deal while discussing the valuations. He pointed out that while investors may decide to trade during market turmoil by leaving the market during peak periods, there is a chance that AI stocks will quickly gain 20% to 30%, making it challenging for investors to return. He is considering this trade from a 2 to 3 year perspective, Clinton noted. This, in his opinion, will provide him with adequate publicity and lessen the possibility that he will miss the wider picture. When it comes to creating graphics processing units and system-on-a-chips, Nvidia is a global leader. Originally driving the gaming industry, its technologies are now driving the revolution in artificial intelligence. Nvidia and Oracle announced their collaboration to expedite the creation and implementation of agentic AI on March 18th. The firms will work together to create 100 Nvidia microservices and more than 160 AI tools in order to do this. Additionally, Nvidia generated $39.3 billion in sales in the fiscal fourth quarter of 2024, a 78% increase from the previous year. The record data center revenue, which increased 93% over the same period to $35.6 billion, was the main driver of the growth. The management reported that Blackwell AI supercomputer sales reached billions of dollars as a result of their effective increase in production. For 2 years, it is the greatest stock to purchase and hold. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Let's start with a little bit of a longer-term perspective that we were looking at earlier this morning and hopefully trying to find some degree of support. How does that look right now?
Yeah, so we are holding this trend line that we had from April of last year, actually, Oliver, here. We actually broke through it earlier this morning, and then we have recovered. And actually, the opening print was pretty much right there on that trend line. What I will say, though, before we kind of go forward, discount everything for today. There's a lot of mechanical things that are taking place, and so we just have to be mindful of that. But the trend line is holding up for now. Let's see how this is going to, how we're going to manage throughout the close here, and then also the next couple of trading sessions. The hammer candle looks pretty decent. It is holding the trend line, but once again, there's a lot that's actually happening mechanically here today that's creating a lot of this intraday volatility. And we kind of talked about it earlier this morning. The quarterly expiration, especially for March, is one of the more intraday volatile days that we have all year. And in fact, we're sitting at around a 2.25% swing from high to low today just alone, which is remarkable to say the least. But we're holding on to this for now. Over the next couple of days, let's see if it's going to act as a firm area of support or if this, once again, I want to call it a mirage, but it could be a mirage, just given the fact that we have not only just the quarterly rebalancing in some aspects, especially when you're looking at some small cap stocks, you have the JP Morgan collar situation taking place here. There's a lot that's happened just as far as individuals maybe placing on new trades, maybe covering short positions that is kind of fueling this intraday rally, as well as also could have been one of the reasons why we saw a sell-off earlier in the session.
Kind of the last line of resort, the Alamo line, if you will. And there are a lot of mirages in the desert, so we'll see. But at least we are holding that area we just came straight down to. Amazing, cutting right to the chase this week. Starting off right where you basically got to hold the line. So let's look at the calendar, kind of zooming in here then on the monthly. I know you got a monthly chart as well. We'll kind of work our way into the intraday because I do kind of think that with the end of the month and the end of the quarter, starting from the top and then going into the daily works best.
Yeah, so if you're kind of looking at it on the month time frame, obviously we had last week that kind of set up with that doji, the bearish engulfing candle. We had another doji. We failed the 20-period moving average, which is in blue there. Then we had this flush candle to the downside. We opened today, and now we're trying to have a hammer candle. We don't know if that's going to be the case yet. There's still 27 minutes left to go in the session, and especially for a day like today, anything can happen. I would not be surprised if we rip and rally to the upside. I would not be surprised if we fade didn't give half of these gains back today, just given the fact here. But for the most part, as we talked about, we're holding that trend line, but we broke that bear flag. Well, we had that bearish candle on Friday that also aligned with a fair amount of volume hitting the tape. And if we are going to see a bounce back and some follow through, that 20-period moving average sitting at around 56.75 is going to be your first key area of resistance. And then the upper end of that, you're going to be looking at the 200-day moving average sitting at around 57.60. And if we break down, you start looking at the 5400 level. We talked about 54.15 that was showing up on the tape earlier this morning. So that would be a breakdown type of scenario that we would get. So that's kind of the 1 month time frame of what has actually already occurred and kind of the setup leading into April.
All right. I mean, we've got worse days. At least we got something here. So the green hammer candle. If we are able to end at the highs, is that how does that rank in terms of bullishness?
Yeah, anytime that you want to see a bullish candle, you want to basically close at or near the highs. And that could happen here today. Once again, if we're looking at it from an intraday basis, this is going to be a key area of resistance already, the 5,600 level. I'm looking at 5,620 that we possibly could get to. Now, the 5-minute chart is going to be very interesting because what we actually had occur here, we had obviously the flush to the downside. We were able to recover. We were in this kind of channel pattern. But what happened around 12 o'clock, 12:30, or I'm sorry, 2 o'clock, 2:30 Eastern time here, we had that JP Morgan collar really hit the tape at 228. Now that trade actually takes place off, I wouldn't say off exchange, but they trade in a block. So when they report it to the tape, the trade's already done with. And so you see a power move to the upside because of the anticipation of that trade hitting the tape. And that's exactly what happened. We see this every single quarter. And we saw that bounce to the upside, pretty much a 30-point move to the upside. That also fueled us, that JP Morgan collar, maybe among other things, but that collar position, once it hits the tape, usually kind of pushes us higher. And into the close, once again, you're going to have this kind of window dressing, people like to call it. You're going to have a lot of activity taking place. I'm looking at 5620 to the upside. If we break down, we could have maybe some pen risk at 5600. I'm also looking at any type of failure getting back into that range or that consolidation channel there at 5570 to the upside, to the downside 5540 to the downside there. So once again, really decent action here. The candle structure today overall looks really good. But if you kind of broaden this out, Ali, what happened with yields today? Yields still went lower on the if you're looking at the grand scheme of things. Dollar really didn't move much. We didn't get any news from the White House regarding tariffs, good, bad, or indifferent. There's nothing coming from the Fed that says anything dovish about this market. That's why I say, the structure looks good, but discount it because nothing else has fundamentally changed. And a lot of those other components that you talk about on a daily basis have not also made any type of meaningful adjustments. And in fact, on the yield complex, yields continue to move lower, which is something that signifies a little bit more risk off.
With an impressive return of plus 177.7% over the course of the year, Nvidia was the fund's best performing investment for a second consecutive year. Since the start of the previous year, Nvidia's Hopper GPUs have been at the forefront of the rapidly growing need for processors that are strong and effective enough to support the energy-intensive needs of AI processes in data centers. With a 95% market share in these chips at first, Nvidia has quickly solidified its position as the industry leader in technology. In March, it introduced Blackwell, the successor to the current Hopper GPU, which prevented companies like AMD and Intel from making significant inroads into the rapidly expanding market. The Blackwell processor is twice as powerful for training AI models and has 5 times the capabilities when it comes to inference, the speed at which AI models answer to queries, as the previous generation, Hopper, which is still driving NVIDIA's extraordinary revenue growth. NVIDIA's financial performance has held up well throughout the course of the year. In their most recent quarter, quarterly revenues reached $35.1 billion, which was a plus 94% year-over-year gain and 6% higher than the consensus estimate. Furthermore, the Hopper H100 chip-driven NVIDIA data center segment increased 5-fold in the last 12 months, highlighting the ongoing need for cutting-edge AI infrastructure. The H100 chip, which costs about $40,000, is still widely used because it can increase the effectiveness of AI model training while reducing expenses overall. NVIDIA is in a strong position to take a sizable chunk of the projected $2 trillion market opportunity over the next 5 years, and this growth is anticipated to continue as businesses spend in modernizing and constructing new data centers. Although there have been some worries that Blackwell production delays have caused share price volatility, Nvidia has quickly recovered thanks to the company's strong earnings results this year and management's promises about future supply. Furthermore, Nvidia's technological leadership is expected to be extended with the release of the H200 chip, guaranteeing sustained progress through 2025. Nvidia's valuation is still up for dispute, but considering its dominant market position, inventive capabilities, and exposure to long-term secular growth patterns in AI, cloud computing, and data infrastructure, the stock still seems reasonable and is not at a substantial premium to history. Because of this, Nvidia is still in a strong position to provide consistent long-term outperformance, which makes it a vital component of growth-oriented portfolios.